So, you want to get into stocks? Thinking about diving into the market? Good for you, seriously. But hold on a second, folks. I got some advice for you. The best advice I ever heard about investing. It came from a millionaire I looked up to as a kid, a real smart cookie. After overhearing him talk about his investments, I wanted in on the action. But I was a complete beginner, totally clueless, so I asked him, how do I pick the right stocks to invest in? His answer was straightforward, and let me tell you, it was a game changer. He said, treat it like finding a girlfriend. Sounds wild, right? But it's pure gold. Trust me on this one. Now, why is that such a clever way to look at it? Think about it. When you buy a share in a company, you become a part owner. That's right, you own a piece of the pie. This is like a partnership, a real partnership between you and the company. You're not just throwing money at some ticker symbol on a screen. You're getting involved. You're betting on their future, and they're betting on your capital. It's a two-way street, a serious commitment. You need to care about that company, just like you'd care about a partner. It's your money, your future on the line. And just like any good relationship, you want this partnership to be happy. You want it to be long. And most importantly, you want it to be successful. Nobody goes into a relationship hoping for a quick, messy breakup. No way. The same goes for investing. We're not looking for those flash-in-the-pan stocks that burn out fast. We want investments that will grow with us, that will be there for us through thick and thin. We're searching for those reliable, strong companies that deliver results year after year. That's the dream, folks. A portfolio that makes you smile, not cry. Of course, when you're just starting out, it all seems incredibly daunting. How do I pick the right stocks? That question can feel overwhelming. It's like asking, how do I find the perfect life partner out of billions of people? It sounds almost impossible, doesn't it? Many beginners feel lost, unsure where to even begin their search. But here's the good news. It's not impossible. Just like in dating, there are methods, there are strategies, there are ways to navigate this world. We're going to break it all down for you, simple and easy. No more fear, just smart, informed moves. Now, let's talk about something important, the allure of get rich quick. Oh boy, everyone hears those sensational stories, don't they? Tales of overnight millionaires, people who bought some obscure stock or crypto and bam, instant fortune. You see those flashy headlines everywhere, but listen up folks, that's the exception, not the rule. It's incredibly rare. For most people, chasing those dreams is like chasing a mirage in the desert. It's mostly hype, and often, it's dangerous hype. Don't fall for that siren song, it can lead your portfolio straight onto the rocks. Real investing, the kind that builds lasting wealth, is a different beast altogether. It's about the long haul, understand? It's about building your financial fortress brick by brick, steadily, patiently. Think of it like running a marathon, not a 100-yard dash. It takes endurance, it takes discipline, it takes smarts and a willingness to learn. It's not about buying a lottery ticket and hoping for a miracle. No, sir. This is about crafting a solid financial plan for your future, a plan that can weather storms and stand the test of time. We're planting seeds today for a harvest years down the road. And please, beware of those online gurus constantly promising you a crystal ball. You know the type. They flash their rented Lambos and claim they know the future. Buy this stock now before it moons, they scream. But ask yourself this, if they were so incredibly good at predicting the market, why would they be selling you their secrets for $99? They'd be too busy lounging on their private islands, counting their billions. Think about it logically. There are no magic formulas here. We're about education, not speculation. We're about doing the homework, not wishful thinking. Our goal here is simple, to help you secure your financial future. We're not interested in helping you make a quick, risky buck that could vanish tomorrow. This is serious business. Your hard-earned money is on the line. And remember, with any investing, your capital is at risk. Your investments can go down as well as up. That's the nature of the game. We want you getting into this for the right reasons, for sustainable, long-term growth. If you're looking for a casino, you're in the wrong place. But if you're ready to build real wealth, then you're exactly where you need to be. Let's circle back to that brilliant dating analogy for a moment. You wouldn't dream of marrying the very first person you swiped right on in a dating app, would you? Of course not. That would be reckless. You'd want to get to know them first. You'd go on dates. You'd ask a ton of questions. You'd want to understand their personality, their background, their dreams, and their baggage. It's exactly the same when you're considering investing in a company. You need to do your homework before you commit your cash. You need to investigate. This means you absolutely need a strategy, a game plan. Think about it. In dating, you usually have an idea of what you're looking for in a partner. Maybe you prefer someone steady and reliable, or perhaps you're drawn to someone more exciting and adventurous. In the stock market, it's no different. You need to figure out your approach. What kind of investor are you? Are you cautious, focused on preserving capital, or are you comfortable with more risk for potentially higher rewards? Your personal strategy will dictate your choices and ultimately your results. Knowing what you want is half the battle. Due diligence, folks, is absolutely key. I can't stress this enough. Research, and then research some more. Before you even think about buying a stock, you need to dig deep. Look at the company's profile in the investing world. That often means looking at things like its balance sheet, understand its numbers, know who's running the show, the leadership team, what's their track record, what are their plans for the future, and what about the competition? You've got to become a financial detective, a veritable Sherlock Holmes of the stock market. Your mission is to uncover the truth behind the ticker symbol. This essay, this whole guide, is designed to be your playbook, your trusted companion on this investing journey. We're going to break everything down for you piece by piece, step by step. No confusing jargon that makes your head spin, just plain, simple talk that everyone can understand. We want to equip you with the knowledge, the tools, and the confidence to navigate the stock market effectively, so you can make decisions based on facts, not fear or hype. Are you ready to learn? Are you ready to take control of your financial destiny? Then let's not waste another minute, let's dive in. Alright, so we've established that investing is like dating. You wouldn't just stumble into a lifelong commitment without a thought, would you? No way. You'd have some idea of what you're looking for, what your deal breakers are, what makes your heart sing. Well, folks, investing is exactly the same. You absolutely, positively need a strategy. It's non-negotiable. Think of it as your GPS in the wild, often confusing jungle of the stock market. Without a plan, you're just wandering aimlessly, and let me tell you, drifting in these financial waters, that's a surefire recipe for disaster, a head-on collision with an iceberg named losses. Your hard-earned cash deserves a whole lot better than that. It deserves a well-thought-out, intelligent plan of attack. Now what happens if you ignore this advice? What if you just dive in head first without a strategy? Chaos. Pure, unadulterated chaos, that's what. You become an emotional yo-yo. You'll find yourself buying stocks when they're sky high, just because everyone on the news is screaming buy, buy, buy. Then when the market sneezes and fear grips your soul, you'll panic sell at rock-bottom prices. It's a gut-wrenching roller coaster, folks, designed by your own worst impulses. You'll end up chasing those glittery, shiny objects, those so-called hot tips whispered by your cousin Vinny at the family BBQ. Bad move. A solid strategy is your anchor. It keeps you grounded, it keeps your emotions in check, it stops you from becoming your own portfolio's worst nightmare. But here's the kicker. Just like in the dating game, there's no single magical strategy that works for everyone. It's personal. Are you the type who's looking for a quick, exciting fling, or are you in it for the long, steady, committed relationship? Do you thrive on adrenaline, a high roller happy to take big risks for potentially massive rewards? Or are you more of a play-it-safe kind of person, focused on protecting your capital and enjoying slow, steady growth? Your approach to picking stocks will, and should, reflect your unique personality and financial goals. The beauty of it all, you get to choose your path. But make no mistake, choose you must. Sitting on the fence is not an option when your financial future is at stake, people. So you're convinced. You need a strategy. Fantastic, that's the first giant step. But now you're probably thinking, okay Jim, what are these strategies? Do I need a mathematics degree from MIT? Do I need to decipher ancient scrolls? Hold your horses. It's not as complicated as it sounds, not by a long shot. Thankfully, there are well-established paths, tried and true methods that smart, successful investors have been using for generations. We're not trying to reinvent the wheel here, folks. We're going to explore the two main schools of thought, the two heavyweight champions in the grand arena of investment strategy. So, buckle up, because understanding these is your next crucial leap towards becoming a savvy, confident investor. This is where the real game begins. Section 2, the two titans, technical versus fundamental analysis unveiled. Alright, let's pull back the grand curtain and reveal the stars of the show. When it comes to stock market strategy, there are two dominant philosophies, two titans constantly vying for the attention of investors worldwide. In one corner you have the agile and fast-paced technical analysis, and in the other corner, the deep-diving and meticulous fundamental analysis. Now, these aren't just fancy, complicated Wall Street terms designed to confuse you. Oh no, they represent fundamentally different ways of looking at stocks, of evaluating potential investments. They utilize different tools, ask different questions, and seek different answers. Understanding this distinction is as crucial as knowing whether you need a magnifying glass or a powerful telescope. Both incredibly useful instruments, but for entirely different purposes and perspectives in this market. First up, let's talk about technical analysis. Imagine these folks as the chart whisperers, the ultimate pattern detectives of the financial markets. They operate on the core belief that all the information you could possibly need about a stock, its past, present, and even its potential future, is already baked into its price movements and trading volume. You'll find them poring over intricate charts and graphs, analyzing historical price data, meticulously searching for recurring patterns and trends. They're on the hunt for those subtle signals, those little winks from the market that scream buy now, or danger, sell immediately. Their primary focus is on the of trades, trying to catch the waves. They're like financial meteorologists attempting to forecast the market's next short-term storm or sunny patch. Then, on the other side of the ring, you have fundamental analysis. These are the true sleuths, the Sherlock Holmeses of the investing universe. They're not content with just looking at the stock's price chart and its daily wiggles. No siree. They dig deeper, much deeper. They want to understand the very essence of the company itself. What's its business model? Is it sound? Is it sustainable? They scrutinize its financial health with a fine-tooth comb, poring over balance sheets, income statements, and cash flow reports. They investigate the leadership team. They assess the industry landscape and the competitive pressures. Their big question is this company a genuinely solid, well-run business that's worth owning a piece of for the long, long haul? It's all about uncovering that intrinsic underlying value, not just chasing those fleeting squiggly lines on a screen. So you see, we're talking about two vastly different creatures here, right? Technical analysis, with its emphasis on charts and short-term price action, is often the preferred playground of short-term traders. Think day traders, swing traders, individuals looking to capitalize on rapid market fluctuations and make quick profits. Fundamental analysis, with its deep dive approach into company health and long-term prospects, is typically the hallowed domain of long-term investors. Think of the legendary Warren Buffett. These are the folks looking to identify and invest in quality companies, holding on to them for years, sometimes even decades, allowing their investments to grow and compound. Now, it's crucial to understand that neither approach is inherently superior or inferior. They simply serve different objectives and cater to different investor temperaments and timelines. Section 3. Decoding the approaches. A first look at your toolkit. So, the big question on your mind is probably, okay Jim, which of these paths is the right one for me? It's a great question. Let's take a slightly closer peek at what the technical approach really entails. This strategy often appeals to those who crave action, who enjoy a faster-paced environment. The day traders, the short-term speculators. Their toolkit is filled with charts, candlestick charts, bar charts, you name it, and a whole battery of technical indicators. You'll hear them talking about things like moving averages, the relative strength index, RSI, MACD crossovers. It can sound like a secret code, I get it. But all these tools are designed with one purpose in mind, to help them spot those elusive patterns in price and volume, patterns they believe can give them an edge in predicting whether a stock is about to pop or drop. Usually in the very immediate future, it's a high-stakes game of speed, precision, and timing. Technical analysis, particularly when it's applied to day trading, is an incredibly challenging mountain to climb. The statistics on the success rate for day traders, well, they're not exactly encouraging. Many credible sources suggest that a staggering majority, upwards of 90%, even 95% of them, end up losing money rather than making it. Why such dismal numbers? Because consistently and accurately predicting short-term market movements is extraordinarily difficult, bordering on impossible for most. It can very easily feel less like disciplined investing and more like high-stakes gambling at a casino. Is it possible to achieve success? Yes, for a very, very small, highly skilled, and perhaps lucky minority. But for most beginners, it's a treacherous path fraught with peril. Now let's shift our gaze and talk a bit more about the fundamental approach. This, my friends, is like becoming a genuine business investigator, a financial detective in the truest sense. You're not just glancing at the superficial blips on a chart, you're delving into the very heart and soul of the company. You're meticulously examining its financial DNA, the balance sheet, the income statement, the crucial cash flow statement. Section 1. The Chart Gazers, peeking into technical analysis. Alright folks, let's roll up our sleeves and talk about this beast called technical analysis. Remember those two big strategies we mentioned? This is one of them, and it's a whole different ballgame. These technical analysts, they're the chart gazers, the pattern seekers. They believe that a stock's price movement and its trading volume tell you everything you need to know. Forget digging through dusty financial reports, they say. The story is written in the wiggles and jiggles of the stock chart itself. They're looking for clues in past trading activity, trying to forecast where that stock is headed next, often in the very near future. It's fast, it's furious, and for some, it's fascinating stuff. Now the core idea behind this whole technical approach is pretty straightforward, at least on the surface. These traders operate on a few key assumptions. First, they believe that the market price reflects all known information. So, no need to study the company's CEO or its latest product launch. It's all supposedly baked into the price already. Second, they believe that prices move in trends. And third, and this is a big one, they believe history tends to repeat itself. They're looking for recognizable chart patterns that have played out before, thinking they'll play out again. Section 2. Riding the Tiger, the high risks of technical trading. Now let's get down to brass tacks, folks. I wouldn't be doing my job if I didn't give you the straight skinny on the risks involved with this technical trading game. Listen up. While the idea of predicting market moves might sound super appealing, for most people, especially beginners, relying solely on technical analysis for quick profits can be like trying to ride a wild, untamed tiger. You might hang on for a thrilling moment, but there's a very, very good chance you're going to get thrown off, and it's going to hurt your wallet badly. I've seen it happen too many times to count. It's a tough road, and it's littered with broken dreams and empty accounts. Remember what I said earlier about day traders? Those folks who live and die by these short-term charts? The statistics are absolutely brutal. Study after study from reliable sources shows that the vast majority of them, we're talking 90%, even 95% or more, end up losing money. Losing, not making a fortune, not breaking even, but actually watching their hard-earned cash go down the drain. Why is it so incredibly difficult? Because short-term market movements are often driven by a baffling mix of news, rumors, algorithmic trading, and pure, unadulterated emotion. Trying to consistently predict that chaos based on past patterns? It's like trying to predict a coin flip. Good luck with that, folks. Section 3. The short-term seduction, why some chase the charts. So, if technical trading is so risky, why do so many people, especially those looking for quick action, get drawn into its web? What's the magnetic pull? Well, part of it is undoubtedly the allure of speed. The idea of making money fast today, not years down the line, is a powerful siren song. Technical analysis offers the promise, however elusive, of defined entry and exit points. Buy when this line crosses that line, sell when this pattern appears. It can feel very systematic, very mechanical, which appeals to people who like clear-cut rules. It's the thrill of the game, the constant challenge of trying to beat the market at its own short-term game. It's exciting, no doubt about it. Another reason short-term traders gravitate towards technical analysis is its focus on liquidity and volatility. These traders thrive on movement. They need stocks that are actively traded, with lots of buyers and sellers, so they can get in and out of positions quickly, without moving the price too much against them. And they love volatility. Those sharp up and down swings, because that's where they see their profit opportunities. A stock that just sits there, stable and boring, that's no fun for a day trader. Section 1. Beyond the surface, uncovering a company's true story. Alright, so we've talked about those chart gazers, the technical traders looking at squiggly lines. Now we're shifting gears, big time. We're talking about fundamental analysis. This, my friends, is where you become a real financial detective. Think Sherlock Holmes, but instead of chasing criminals, you're chasing the truth about a company. It's not about just looking at the pretty pictures, or the stock price doing a little dance. Oh no, this is about getting under the hood, understanding the engine, and figuring out if this company is built to last. Remember our dating analogy? This is like really truly getting to know your potential partner, their character, their family history, their financial stability, the whole 9 yards. Not just swiping right on a flashy profile picture. This is serious business, folks. So what's the big idea behind fundamental analysis? It's all about uncovering a company's intrinsic value. Fancy words, I know, but it just means what the company is really worth. Deep down. Not what the crazy, emotional, day-to-day market says it's worth, because let me tell you, the market can be a moody teenager sometimes. This approach is for the patient investor, the long-term thinker, the person who wants to find solid, reliable companies that are going to grow their wealth steadily over the years. We're not looking for a one-night stand here, we're looking for a marriage. A partnership that will stand the test of time and deliver real, tangible results for your financial future. It's about substance, not just sizzle. Section 2. The balance sheet, a financial snapshot, your company's profile. First up on our financial deep dive is the balance sheet. Now, if you're checking out someone's profile on a dating app, you're looking at their pictures, reading their bio, trying to get a quick sense of who they are, right? Well, the balance sheet is kind of like that for a company. It's a financial snapshot, a picture of what a company owns and what it owes at one specific moment in time. Think of it like taking a photograph. It captures everything as it is, right then and there. It tells you about the company's assets, its liabilities, and the shareholders' equity, which is basically the owner's stake in the company. It's a fundamental piece of the puzzle, folks, a real window into the company's financial standing. Now let's talk about assets. These are the goodies, the valuable stuff the company owns. Remember that cookie jar analogy I mentioned? Current assets are like the cookies right at the top, the ones you can grab and eat quickly. For a company, this means cash or things that can be turned into cash within a year, like money owed by customers. That's accounts receivable. Then you've got long-term assets. These are like the cookies buried deeper in the jar, meant to last. This includes things like the company's headquarters, its factories, and its equipment. And don't forget intangible assets. These are the invisible things that make the cookies taste amazing, like patents, trademarks, and that all-important brand recognition. You can't touch them, but boy, are they valuable. Next up, we have liabilities. This is the other side of the coin. These are the company's obligations, what it owes to others. Think of these as the cookies you've already promised to your friends because you borrowed their fancy sprinkles and chocolate chips. Current liabilities are the debts that need to be paid back relatively soon, usually within 1 year. This could be money owed to suppliers or short-term loans. Then there are long-term liabilities, which are debts due further down the road, like bonds or bigger loans. Understanding a company's debt situation is absolutely critical. You don't want to partner up with someone who's drowning in IOUs, do you? Same goes for companies. So, now you know what all this information means, what should you do with it? Well, there's a nifty little calculation you can use to quickly check a company's short-term financial health. It's called the current ratio. You take total current assets and divide them by total current liabilities. As a rule of thumb, you want this number to be above 1. That means the company has more short-term assets than short-term debts. Let's take Coca-Cola, for example. Their total current assets were around $26.73 billion. Divide that by their total current liabilities, which were about $23.57 billion. What do you get? Roughly 1.13. This means Coca-Cola has $1.13 in current assets for every $1 in current liabilities. That's a good sign, folks. It shows they can cover their immediate bills. But our detective work isn't over yet. Section 3. The income statement. Checking the report card. Past performance. Alright, we've looked at the company's financial snapshot with the balance sheet. Now let's dig into its past performance. When you're getting to know someone, you're probably curious about their track record, maybe their past relationships, right? You want to see how they've handled things before. The income statement is kind of like that for a company. It's their report card. It tells you how well the company performed financially over a specific period, like a quarter or a whole year. Unlike the balance sheet, which is a snapshot in time, the income statement shows you the flow of money, how much the company made, and how much it spent to make it. This is where you see if the company is actually making a profit. At the very top of the income statement, you'll find total revenue. This is the big number, folks. It represents the total amount of money the business earned from its sales during that period. For a giant like Coca-Cola in 2023, they raked in a whopping $45.75 billion in revenue. Not too shabby, eh? But that's not the whole story. A company also has expenses. There's the cost of revenue, which is what it costs them to actually produce their goods. Think about it. If you're selling custom t-shirts, you've got to pay for the blank shirts and the printing. For Coke, it's the ingredients, the bottles, the cans. Then you have operating expenses. These are the costs of running the business, like marketing, salaries for the sales team, and rent for their offices. Now, after you subtract the cost of revenue and all those operating expenses from the total revenue, you get to a really important number: operating income. This tells you how much profit the company made from its core business operations, before things like taxes and interest payments. It's a key indicator of how efficient and profitable the underlying business really is. Using that t-shirt example again, you sell a bunch of shirts, revenue, subtract the cost of the shirts and printing, cost of revenue, subtract your marketing and website costs, operating expenses, and what's left is your operating income. It's the same idea for massive companies, just with much bigger numbers. This is a critical figure to scrutinize. So, why does this operating income matter so much? Well, here's another simple calculation to see if a business is generating a healthy profit. Take that operating income, divide it by the total revenue, and then multiply by 100 to get a percentage. This is your operating profit margin. According to the folks at Tide Banking, a good rule of thumb is that 5% is a low profit margin, 10% is considered healthy, and anything around 20% or more is a high profit margin. If we plug in Coca-Cola's numbers, they boast an operating profit margin of around 25.73%. That's high, folks. That's a great sign. However, always remember that older, more established companies often have higher margins than newer, fast-growing companies that are reinvesting everything back into growth. Amazon, for instance, took years to become consistently profitable, and look at them now. So context matters, as always. Section 4. The cash flow statement is the money flowing, right? Okay, team, we've checked the company's profile with the balance sheet and its report card with the income statement. But there's one more critical piece of financial detective work we need to do: checking out their cash flow statement. Listen, it might not sound romantic, but if you're thinking about a long-term commitment, you don't want your partner to be financially irresponsible, right? Money problems are a huge reason relationships go south. Trust me on this one. The same exact principle applies to companies. You don't want to invest your hard-earned money in a company that can't manage its cash properly. That's why the cash flow statement is so darn important. It shows exactly how much cash is coming into the company and how much is going out over a specific period. The cash flow statement is typically broken down into 3 main parts, and they sound a bit jargony, but they're super simple once you get them. First, you have cash flow from operating activities. This is the cash generated from the company's normal day-to-day business operations. For Coca-Cola, this is the cash they get from selling their sodas and other beverages. What you're looking for here, plain and simple, is a positive number. A nice, healthy, positive number. This means the company's core business is actually bringing in more cash than it's spending to run those operations. That's a very good sign, folks. It means the business is self-sustaining from its primary activities, which is exactly what we want to see. Next up is cash flow from investing activities. This section tracks the cash spent on investments in the company's future, or cash received from selling those investments. This includes buying new property, plants, or equipment, or even acquiring other companies. Now here's a tricky part. A negative number here isn't necessarily a bad thing. In fact, it can be a very good thing if it means the company is reinvesting in itself, upgrading its machinery, or expanding its operations to fuel future growth. I always like to see companies wisely investing in their future. You just want to be cautious that they're not spending too wildly, or, conversely, selling off a ton of their core assets, which could be a red flag indicating trouble. Finally, we have cash flow from financing activities. This part deals with how a company raises capital and pays it back to investors or creditors. It includes cash inflows from borrowing money or issuing stock, and cash outflows for repaying debt or paying dividends to shareholders. You need to keep a close eye on this section to see how the company is managing its debt and its dividend payments. Be wary if a company is relying too heavily on borrowing money year after year, or if it's paying out huge dividends while its overall cash flow is negative. That's like winning a small lottery prize, quitting your job, and then showering all your friends with expensive gifts. It's just not sustainable. Eventually, the cash will run out. Thankfully, for a company like Coca-Cola, even though they distributed billions in dividends, around $7.95 billion recently, their strong positive cash flow from operations shows they can comfortably afford it. That's financial responsibility. Perfect. All right, so you've crunched the numbers, you've looked at the balance sheets, the income statements, the cash flow. Everything looks pretty darn good on paper. But then, have you ever been on a date with someone who seemed absolutely perfect based on their online profile? Great job, nice hobbies, fantastic pictures, but when you finally met them in person, there was just nothing, no spark, no real connection? Well, folks, believe it or not, the same thing can happen with stocks. A company might look like a statistical dream, a mathematical marvel, but there are crucial factors that those spreadsheets and financial reports simply cannot capture. This is where we need to go beyond the digits. This, my friends, is where qualitative analysis struts onto the stage. What in the world is that, you ask? Simply put, it's about exploring all those aspects of a company that aren't strictly numerical. It's about looking at the quality, not just the quantity. Think about a company's reputation, how much people recognize its name, the loyalty of its customers, the vision of its leaders, and its overall standing in the world. These are the intangible elements, the things you can't easily plug into a formula, but they can make or break an investment. It's about embodying your inner Sherlock Holmes once again, folks, looking for clues that aren't immediately obvious but are incredibly telling. Why bother with all this fuzzy stuff when you have cold hard numbers? Because numbers, as useful as they are, don't always tell the whole story. Sometimes they can even be misleading if you don't understand the context behind them. Qualitative factors often paint a much richer picture of a company's long-term prospects, its resilience in the face of challenges, and its potential for genuine sustainable growth. It's about understanding the company's character, its moat against competitors, and the strength of its relationship with its customers. Neglecting these aspects is like trying to understand a person by only reading their bank statement. You're missing a huge part of who they truly are. So, as we dive into this qualitative world, it's not about just going with a vague gut feeling. No siree. While intuition can play a small part, true qualitative analysis is a systematic process of investigation. There are specific, crucial non-financial factors you need to scrutinize to really dig into. These factors can give you incredible insights that you simply won't find buried in a financial report. They can help you spot the true champions, the companies built to last, and avoid those that might look good on the surface but are rotting from the inside. Ready to become a master of reading between the lines? Let's get to it. First up in our qualitative treasure hunt is a giant one-brand recognition. Think about it. If I asked 100 people on the street what they think about Apple, what kind of responses would you expect? Mostly positive, right? You'd hear about their sleek designs, their user-friendly products, maybe their strong stance on privacy. Most folks out there probably own at least one Apple device, and the company has built an incredibly loyal, almost fanatical customer base. Now what if I asked those same people about a lesser-known tech brand, say Xiaomi? Especially if you're in the US, you'd probably get a lot more blank stares, even though Xiaomi is a massive player in other parts of the world. That difference, folks, is the power of brand recognition. And let me tell you, that power is worth its weight in gold, maybe even more. Companies with super strong brand recognition, the ones everyone knows and trusts, have a massive advantage. They've built up a reservoir of goodwill with their customers. This means that when a new competitor pops up, or when there's a bit of market turbulence, these strong brands are much less affected. Their customers stick with them. It's like they're the king on the chessboard, as the saying goes. Every move kind of revolves around them, and their position is so central, so established, that they become incredibly difficult to displace. For you, as an investor, this translates into lower risk. You're betting on a proven winner with a loyal following. Now, let's shift our focus to another absolutely critical qualitative factor, the company's leadership. Who is steering the ship? This is paramount. You wouldn't want to invest your hard-earned money in a company run by clowns or crooks, would you? Of course not. So, you need to do your homework. Research the company's board of directors. Read the transcripts of their earnings calls. That's where the CEO and CFO talk directly to investors and analysts. Check out the LinkedIn profiles of the top executives. How long have they been with the company? Generally, the longer the key leaders have been in charge, the more knowledgeable and experienced they are, which often translates into a higher likelihood of success. You want leaders with a clear vision and a proven track record. And in today's hyper-connected world, the influence of company leaders, especially the CEO, has become even more pronounced. Many CEOs now have massive followings on social media platforms like Twitter. This can be a double-edged sword, let me tell you. With the power to influence millions of people and stock prices with a single tweet, it's a wild ride. Remember back in 2016 when Donald Trump tweeted about the F-35 fighter jet program, calling its costs out of control? That program was a Lockheed Martin project. What happened? Lockheed Martin's stock price took an immediate nosedive, wiping out billions in market value in a flash. So it's becoming more vital than ever to invest in companies led by sensible, responsible, and articulate CEOs. Otherwise, one ill-advised tweet could send your investment on a very bumpy and unpleasant journey. Alright, let's talk about the third crucial piece of our qualitative puzzle: uncovering a company's competitive advantages. What makes this company stand out from the crowd? What's its unique secret sauce that keeps customers coming back and competitors at bay? This, folks, is a huge deal. These advantages can take many forms. It could be a portfolio of valuable patents that protect its unique technology. It might be an incredibly loyal customer base that wouldn't dream of switching to a rival. Or perhaps it's a disruptive business model that has completely changed the game in its industry. Identifying these advantages is like finding hidden treasure for an investor. These competitive advantages are what truly set a company apart and give it staying power. They act as a protective moat around the business, making it difficult for rivals to encroach on its territory. Think about Tesla, for example. They've managed to secure a massive competitive advantage through their cutting-edge electric vehicle technology and their expansive proprietary supercharger network. That network alone is a huge barrier to entry for other automakers trying to catch up. Companies with strong, durable competitive advantages are often able to generate higher profits, expand their businesses more quickly, and deliver superior returns to their shareholders over the long haul. For you, the investor, this means lower risk and, critically, much bigger potential rewards. So, how do you find this secret sauce? It's not always going to be neatly listed in an annual report, though sometimes companies do highlight their strengths. You've got to put on your detective hat again. Start by thoroughly exploring the company's website, especially the About Us and Investor Relations sections. Dig into industry reports and analyses to understand the competitive landscape. Read news articles and business publications that cover the company and its sector. And don't underestimate the power of a good old-fashioned Google search. Yes, it takes time. Yes, it requires effort. But understanding these underlying competitive strengths could be the difference between a mediocre investment and a truly spectacular one. Remember, folks, research is your absolute best friend in this investing game. It's far, far better to spend a couple of extra weeks or even months thoroughly researching a company, understanding its financials, its brand, its leadership, and its competitive advantages, than to make a rushed investment based on a hot tip or a gut feeling, and then watch it backfire spectacularly. Qualitative analysis, when combined with solid financial analysis, gives you that full 360-degree view you need to make truly informed decisions. This deep understanding builds conviction, which is essential for staying the course during inevitable market ups and downs. Don't skimp on this vital work. Your future portfolio will thank you for it. The news noise machine. Don't let it rattle your cage. The rumor mill. It's always churning, isn't it? Someone whispers something nasty about the person you're seeing. Do you dump them? Instantly? Right there on the spot? Without even checking if it's true? Some folks do, and believe me, it's the same with stocks. Bad news hits the wires. Boom! They hit the sell button. It's pure emotion, folks, no thinking. Just raw, unfiltered fear. And let me tell you, that's a dangerous, dangerous game to play with your financial future. Your hard-earned money deserves a whole lot better than that kind of knee-jerk reaction. News is powerful, unbelievably powerful. You want to see power? Remember the great toilet paper scare a while back? Shelves totally empty, chaos in the aisles. Why did it happen? Pure, unadulterated panic. The news screamed shortage, day in, day out. So what did everyone do? They ran out and bought every last roll. The news itself, the reporting, it made the situation 1,000 times worse. If they hadn't fanned those flames of fear, guess what? No panic. Plenty of toilet paper for everyone. That, my friends, is the incredible power of the news cycle. This news power, it can hit the stock market like a Category 5 hurricane. Sometimes, sure, a piece of fantastic news sends a stock soaring. Right up to the moon, we love to see that. But more often than not, bad news, scary headlines, whispers of disaster, they cause extreme panic selling. Fear grabs hold of investors by the throat, and people just run for the exits. They don't stop to think. They don't analyze. They just sell. Even if the supposed fire isn't real or just a tiny little flame, it becomes a stampede, folks. And stampedes are always dangerous. Take Facebook, now Meta, for example. Remember the Cambridge Analytica scandal back in March 2018? Personal data unethically taken. The headlines were brutal, absolutely ugly, and the stock, it took a nosedive down nearly 18% in just 10 short days. Investors freaked out, they bailed. But now let's zoom out. Let's look at the bigger picture, the long-term view. That very same stock, it has since increased by more than 200%. For those long-term investors, the smart cookies who understood the situation, the ones who trusted their research, it was just a blip on the radar. They held strong. They didn't blink. So we've established it. The news is often just a fear factory, a non-stop noise machine cranking out doom and gloom, often designed to make you jumpy, to make you react. If that's the reality, then how in the world do you really know when to sell a stock? It's a massive question, isn't it? Probably one of the biggest you'll face as an investor. Get it wrong, and it can seriously hurt your portfolio. You absolutely gotta have an answer. A smart, reasoned answer. Not a scared, panicked one. You need a strategy, not just a reaction. Here's the secret, folks. And listen closely, because this might not be what you're expecting to hear. The best, most legitimate reasons to sell a stock, they depend entirely on you. That's right, your life, your personal financial situation, your specific goals. Not on the screaming headlines from Wall Street, not on what your brother-in-law heard at the golf course. It's all about your personal financial playbook. You are the coach of Team U. You call the important shots, not some talking head on TV. Never forget that. So, what's a valid reason to consider selling? Reason number one, a genuine financial emergency. Life throws curveballs. It just does. The roof springs, a massive leak. The car engine blows up. Unexpected medical bills pile up. If you find yourself in a real, honest-to-goodness financial jam, and you don't have an emergency fund stashed away, which you should, by the way, selling some of your shares might become a regrettable necessity. It's tough, no doubt, but it's about getting yourself out of that sticky wicket. Your immediate financial well-being has to come first, always. Now for a much happier reason to sell. Reason number two, you've hit your financial goal. Hooray! Maybe you were diligently investing to save up for that down payment on your dream house. Or perhaps it was for that once-in-a-lifetime trip around the world. Or maybe it was for your kid's college education fund. If you've reached a specific financial target that you set for that particular investment, and you would feel genuinely satisfied and happy selling at that price point, then go for it. Take those profits. Enjoy your hard-earned gains. Celebrate your success. That's precisely what disciplined investing is for. Alright team, there's one more big, crucial reason to sell a stock. And this one is all about the company itself. It's not about market panic. It's not about sudden cash needs. This is a strategic move. A thoughtful, calculated decision. It's about looking at your investment with clear, objective eyes, and having the guts to make a tough call if the situation demands it. This, my friends, is what investing like a seasoned pro looks like. It's about brains over raw emotion every single time. You need to be honest with yourself. So, what's this third critical reason? You sell when you genuinely no longer believe in the fundamental strengths of the company, or if you've lost faith in its future trajectory. It's as simple and as complicated as that. Maybe the visionary CEO who built the company has retired or left. Maybe a new, aggressive competitor has emerged and is starting to eat their lunch. Maybe the entire industry has undergone a seismic shift for the worse. If your original reasons for buying that stock in the first place are gone, vanished into thin air, poof, then your reason to continue holding it might just be gone too. This decision isn't about the stock price taking a little dip yesterday, or because you read some scary, sensational story on page 6 of the newspaper. No, absolutely not. This decision comes from your deep, diligent research, your qualitative analysis that we talked about, your fundamental detective work. You've reevaluated the company from top to bottom, and you've come to the sober conclusion that it's no longer the long-term winner you initially thought it was. It's a deliberate, well-reasoned choice, based on solid facts and your own hard analytical work, not on fleeting fear or market noise. See the massive difference there? These valid reasons for selling covering genuine emergencies, joyfully hitting your financial goals, or recognizing a fundamental negative change in the company, they're all about you and your careful assessment of the situation. They are a million miles away from emotional, news-driven panic selling. That kind of selling, that's just gambling with your emotions, and the house usually wins. This, what I'm talking about, is taking control of your investments. This is smart, disciplined investing. This is how you protect and grow your hard-earned money. And that, my friends, is always the name of the game. So, we've been on quite a journey, haven't we, folks? From treating stocks like finding a partner, to digging through those financial statements like a true detective. You've learned that you can't just pick any company willy-nilly. It takes research, it takes strategy, and it takes understanding. Just like in the dating world, not every potential partner is the same. Some are steady and reliable, others are exciting and full of rapid potential. When it comes to stocks, you've got to figure out what type suits your investment personality and your long-term financial goals. This is a crucial step, so listen up. Now, one of the main ways we categorize stocks is by thinking about value versus growth. Let's talk value stocks first. These are often shares in large, well-established companies. Think of them as the strong, silent types in the dating world. Dependable, maybe not the most thrilling, but they've got a solid foundation. These companies usually have stock prices that seem a bit low compared to their financial performance. They often have a lower price-to-earnings ratio, meaning you get good earnings for the price. Plus, they frequently pay dividends, sharing their profits with you, the shareholder. They're the kind of companies that people rely on, even when the economy gets a little rocky. Then you've got the growth stocks. These are the exciting high-energy partners, the ones with dazzling potential. These companies are often in rapidly expanding industries, and investors expect them to grow much faster than the overall market. Their stock prices might seem high, and they usually have higher price-to-earnings ratios. Why? Because investors are betting big on their future. These companies typically reinvest any profits back into the business to fuel even more growth, so they often pay little to no dividends. Think of tech innovators or companies breaking new ground. It can be a wild ride with big ups and potentially big downs too. So how do you tell these two types apart? A quick way is to look at that PE ratio, the price-to-earnings ratio, which you can find easily on platforms like Robinhood. Generally, a PE ratio around 20 to 25 is considered average. Anything below that might suggest a value stock, while anything significantly above could point to a growth stock. But hold on, folks, this is just a rule of thumb. It varies a lot by industry. So, always compare a company's PE ratio to other companies in the same sector. Ultimately, deciding between value, growth, or even a mix of both comes down to your personal risk tolerance and your investment timeline. Alright, so you've started thinking about whether you prefer value sweethearts or growth dynamos, but just like in dating, you probably wouldn't want to pin all your hopes and dreams on just one person right away. That's a lot of pressure and a lot of risk. The same exact principle applies when you're building your investment portfolio. You don't want to put all your hard-earned cash into a single stock no matter how much you love it. That's like betting your entire future on one roll of the dice, and let me tell you, that's not investing, that's gambling. We're here to build wealth wisely, not to play Russian roulette with your retirement. This is where the beautiful concept of diversification comes into play. Say it with me, diversification. It's one of the most important words in the investor's dictionary. What does it mean? Simply put, it means spreading your investments across a variety of different assets. Don't put all your financial eggs in one basket. If one of your stocks takes an unexpected nosedive, and trust me, even the best companies can have bad days or bad years, You're banking on your other investments to help balance things out. It's like having a well-rounded group of friends. If one is having a tough time, the others can offer support. This is your financial safety net, folks. Now there are some handy rules of thumb for good diversification. A general guideline is not to have more than 5% of your investment money tied up in any single stock. That way, if one company goes belly up, it doesn't sink your entire portfolio. Also, try not to concentrate more than about 20% of your investments in any single sector, like technology or healthcare. You should aim to have stocks in at least 5 different sectors of the economy, and think globally. Consider investing in companies from at least 2 different countries. Aim for a portfolio with more than 25 different stocks in total to achieve a good spread. But diversification isn't just about owning a bunch of different stocks. It's about owning different of stocks. Stocks from different industries, different geographic regions, and companies of different sizes. This helps protect you from various economic conditions that might affect one part of the market more than another. It's about creating a balanced team of investments that can work together to help you achieve your long-term financial goals, smoothing out some of the inevitable bumps along the road. This thoughtful approach to building your portfolio is absolutely key to managing risk and improving your chances of long-term success. It's smart, it's prudent, and it's what savvy investors do. Throughout this journey, from understanding financial statements to exploring different stock types, there's one theme I keep coming back to, and it's absolutely crucial. Investing is a marathon, folks, not a 100-yard dash. We're not trying to get rich overnight. We're trying to build sustainable, lasting wealth over time. That means patience is your superpower. You need to give your investments time to grow, time for the power of compounding to work its magic. There will be ups, there will be downs, the market will wiggle and jiggle, but the long-term trend for solid investments has historically been upwards. So stay the course, trust your research, and don't panic. Another piece of long-term wisdom? Think about your investing. There are smart ways to give your savings an extra boost. For example, consider opening tax-advantaged accounts. In the USA, you've got things like a cash IRA, which is an individual retirement account. These accounts can allow your money to grow tax-free or tax-deferred, which can make a huge difference over many years. Robinhood, for instance, often has competitive rates on these. The point is, look for ways to make your savings work even harder for you. Every little bit of tax efficiency helps you reach your financial goals sooner. It's about playing the long game intelligently. Now, I get it. After hearing about balance sheets, income statements, qualitative analysis, and picking individual stocks, some of you might be thinking, Jim, this sounds like a lot of work. And you're right. It can be time-consuming to do all that deep dive research properly. If picking individual stocks feels too daunting, or if you simply don't have the hours to dedicate to it, don't despair. There is a way you can cut out pretty much all that individual company research, and in many cases, get even better results. I'm talking about index fund investing. These funds hold a basket of stocks, often tracking an entire market index like the S&P 500. With index funds, you get instant diversification across hundreds, sometimes thousands of companies. It's a fantastic option for many investors, especially those who prefer a more hands-off approach. If you want to understand how this simpler strategy can generate significant wealth, perhaps even making thousands a week as I do with my own index fund investments, there's more to learn. But for now, remember the core principles. Invest for the long term, diversify your holdings, and stay informed. Whether you choose individual stocks or index funds, the goal is to grow your wealth and secure your financial future. You've got the basics now. Go out there and make smart choices.